Buckle up, folks, because the Hong Kong stock market has just had a wild ride last week. The Hang Seng Index jumped a whopping 8.8%, and tech-heavy Hang Seng Tech Index surged an even more impressive 17.43% compared to the A-share stock market or other global markets. Hong Kong stocks are absolutely shining star right now. So, what's behind the sudden surge in Hong Kong stock? And is it time to jump in on the action? I'm Sheila Wang. I'm here to update it on the most cutting-edge and fresh businesses and investment information for you. So don't forget to smash the like button and subscribe my channel. I also welcome you to join the discussion in the comments below. And if you're interested in a more in-depth investing report, make sure to check out my analysis report down below. Now, let's dive into today's topic together. You will get answers about these two burning questions. The first one, why is a rally? The truth is, Hong Kong stocks have been lagging behind their A-shares counterparts for a while now, since its peak of over 31,000 points in early 2021. The Hang Seng Index has been on a downward spiral, hitting a low of around 40,800 points. That's a gut-wrench drop of over 53%. Even after recent rebound, it's still hovering below 80,000 points. This prolonged and significant decline has pushed the valuations of Hong Kong stocks to incredibly cheap levels, both compared to global markets and historically. Now, don't get me wrong, because cheap doesn't automatically mean it's going to skyrocket tomorrow, right? Short-term fluctuations need a little push. And for the recent Hong Kong rally, there are two main suspects: influence and opportunities. The Hong Kong stock market is like a bustling international airport, filled by both domestic and international capital flows. What we call domestic capital flows as southbound surge. Since February, southbound funds have been pouring into the Hong Kong market, with net purchases through Stock Connect reaching a whopping 206.3 billion Hong Kong dollars this year. That's nearly two-thirds of last year's total inflow in just a third of the time. Let's take a look at the policy power up. On April 19th, the China Securities Regulatory Commission announced 5 new measures to boost the cooperation between mainland China and Hong Kong's capital markets. These measures definitely provide much-needed liquidity and injects confidence into the market. I'd like to break down 3 of the most impactful measures. The first one is ETF expansion. More ETFs are being included in Stock Connect, significantly expanding the range of investment options available. It is a massive upgrade to the market menu. The second one is RMB access. Get ready to buy Hong Kong stocks directly with your yuan. This is a game changer, opening up new avenues for mainland investors. And the third one is IPO powerhouse. Leading mainland companies will be encouraged to list on the Hong Kong Stock Exchange. This move will bring more high-quality assets to the market, providing investors with even more choices. So what we can see as the immediate impact of these policies is an influx of fresh capital, something Hong Kong has been craving for years. But who are the potential big spenders? Well, think big institutions like social security funds and insurance companies. These heavyweights are drawn to the attractive valuations of Hong Kong stocks, and the new policies will streamline their investment process. Another thing we can suppose is that quantitative funds could also be drawn in. Although their participation is harder to predict, these high-frequency traders are sensitive to currency fluctuation. While it might take some time for them to jump in, the potential is definitely there. Well, as for the foreign front, Many international financial institutions have shifted their stance from bearish to bullish on China's economy. And let's not forget about the unexpected depreciation of the Japanese yen, which has made Japanese stocks less appealing, right? And you've got foreign investors returning to Hong Kong market. Another change I have to mention here is improved expectation as financial reports that catalyze fundamental changes. The main operations of major Hong Kong listed companies are based in mainland China, and their fundamentals are greatly influenced by the domestic microeconomic environment. In the short term, the overall change in fundamentals of Hong Kong stock market is not significant. However, technology and internet companies play a significant role in the Hong Kong stock market. Recently, there has been continuous positive news for some leading internet companies, such as Tencent's scheduled release of DNF mobile game, better than expected performance in Meituan's co-local life business, and better than expected performance in PDD's overseas business. All of these developments have strengthened expectations for improved fundamentals and have driven the overall market to rise. Well, in order to help everyone better understand and assess whether there are investment opportunities in Hong Kong stock market, we have listed the reasons why the current valuation of Hong Kong stocks is considered undervalued. This will assist you in considering whether the main factors that cause the undervaluation of Hong Kong stock market have been eliminated or changed. The first one is for larger Chinese internet companies. Apart from the short-term performance being affected by the microeconomic environment and going through a period of recovery, the underlying fundamentals that determine their value have not fundamentally changed. Companies like Alibaba, Tencent, and Baidu are actively expanding establishing their presence in the field of AI area, which is a demonstration of their search for new business value. So you can just mirror this point and think twice about is that a good point to invest in Hong Kong stock market. Another objective reason is that the constituents of the Hang Seng Index is benchmarked in the US market, and the decline in benchmarked US companies have been much smaller than that of Hong Kong listed companies. And the third one is previous rapid increase in the US 10-year Treasury yield from 0% to over 4% due to the Federal Reserve's aggressive rate hikes lead to overseas investors reevaluating their stock and bond portfolios, resulting in a strong liquidity shock to the Hong Kong stock market. So you can keep a close eye on these rates. Fourth factors that you need to take consideration are there still uncertainties, such as ongoing pace of rate hikes by the Federal Reserves, the outcome of the delisting of Chinese concept stocks, and US-China relationships. Even though the fundamentals have shown undervalued, there are still risks in attempting to buy stocks at the bottom of the short term. What's more, currently the prices of many industries in the primary and secondary markets in Hong Kong have become inverted. Assuming that Hong Kong market becomes a primary institutional investment market that opens every 3 or 5 years, many companies are still valuable from this perspective, right? Therefore, the current prices are still very attractive. Furthermore, the pricing power in the Hong Kong stock market is mainly in hands of foreign capital. Due to the loose monetary policy currently implemented domestically, southbound funds will not face a crisis or liquidity shortage. Instead, due to the downward adjustment of deposit rates and the real estate sector remaining at a low level, substantial savings could become a driving force for the future rise of Hong Kong stocks. So above all, from a trading perspective, considering the characteristics of Hong Kong stock market, we suggest considering a slightly conservative approach, waiting for signals of improved fundamentals and liquidity, and participate in the initial stage of the upward trend, rather than simply buy more as the prices fall. Currently, Hong Kong stocks have experienced significant decline in valuation over the years, and even after last week's rebound, they still remain relatively inexpensive. Coupled with the recent improvement in liquidity, we believe that it is still worth paying attention to Hong Kong stocks in the future. However, we still need to caution about the risks. The recovery of domestic fundamentals is still being validated, and the global stock markets are still under pressure as expectations of interest rate cuts by the Federal Reserve fade. Of course, investing in the challenging Hong Kong stock market is not a must, but if you choose to participate in it, it is advisable to control your position and make a good plan. From an industry perspective, if I were to rank them, I personally believe that technology and internet sectors, as well as the biotech sectors, are more severely undervalued. For more specific details, please stay tuned for my in-depth report. So see you next time, my friend.